Imagine you have $30,000. It's January 2020. The economy is booming. Optimism is high. And you decide it is finally time to stop saving money and start building real wealth. You want passive income. You want to live off dividends. So, you look at the three biggest financial titans on Wall Street: Vanguard, Charles Schwab, and Fidelity. But which one actually makes you richer? Today, we are not just looking at boring spreadsheets. We are going to simulate the ultimate dividend ETF battle. 3 investors, $30,000 each, 1 catastrophic market crash, and a 10-year race to financial freedom. By the end of this video, you will see exactly how much capital they have by December 2025. And more importantly, how much passive income their portfolios will print out by the year 2030. Welcome to the ultimate lazy portfolio showdown. Ready to build your passive income fortress? Hit the subscribe button and let's rewrite your financial story. Meet our 3 investors: Claudia, Eduardo, and Michaela. They are all 100% committed to a set and forget dividend strategy. No daily trading, no panic selling. Just buy, hold, and let the magic of compound interest take over. First, we have Claudia. Claudia loves safety and history. She chooses Vanguard's High Dividend Yield ETF, ticker symbol VYM. VYM tracks over 400 companies. It gives her massive diversification, leaning heavily into solid, old-school sectors like financials and consumer staples. She invests her $30,000. Next is Eduardo. Eduardo doesn't just want high dividends today. He wants high-quality companies that grow their dividends every single year. He chooses Schwab's U.S. Dividend Equity ETF, ticker symbol SCHD. SCHD is famous for its strict quality filter. It only accepts companies with at least 10 consecutive years of dividend payments. He locks in his $30,000. Finally, we have Michaela. She wants high yield, but she also wants a bit more exposure to the modern economy. She chooses Fidelity's High Dividend ETF, ticker symbol FDVV. FDVV's unique algorithm often gives it slightly more exposure to the tech sector compared to traditional dividend funds. Her $30,000 is officially in the market. And then, March 2020 happens. The global health crisis hits. The world shuts down. In a matter of weeks, the stock market enters a terrifying freefall. Panic is everywhere. News anchors are screaming to sell everything. But remember the golden rule of our 3 investors? No panic selling. In fact, they do something brilliant. They keep their DRIP turned on. DRIP stands for Dividend Reinvestment Plan. When the market crashes, the dividend payouts they receive are automatically used to buy more shares of their ETFs at a massive discount. They aren't just surviving the crash. They are secretly accumulating more shares while everything is on sale. As 2020 ends and 2021 roars to life, the market experiences a historic recovery. Because our investors automatically reinvested their dividends at the absolute bottom, their portfolios explode upward. The VYM, SCHD, and FDVV engines are firing on all cylinders. But the stock market is never a straight line up. Enter 2022. Inflation skyrockets, the silent thief of wealth. Interest rates are hiked. The tech sector gets absolutely crushed. This is where the differences in these 3 ETFs truly show their colors. Michaela's FDVV, which had that nice tech exposure, feels the burn a bit more. But Claudia's VYM, loaded with boring but essential companies like banks and consumer goods, holds up like an absolute fortress. And Eduardo's SCHD, because it only holds cash-rich, high-quality companies. It barely flinches during the 2022 bear market. Through the ups of 2021, the downs of 2022, and the massive artificial intelligence rally of 2023 and 2024, the DRIP machine never stops. Every quarter, Vanguard, Schwab, and Fidelity deposit cash into their accounts, and that cash buys more shares. This is the 8th wonder of the world in action. Compound interest visualized. Fast forward to December 2025. It has been exactly 5 years since they invested their hard-earned $30,000. They haven't added a single penny of their own money since that first day. Let's open the vault and see who won the 5-year sprint. In 3rd place for total capital growth, we have Claudia and Vanguard's VYM. Her initial $30,000 has grown to a highly respectable $53,000. She has nearly doubled her money with extreme safety and minimal volatility. VYM did exactly what it was supposed to do. act as a financial anchor. In second place, we have Eduardo with Schwab's SCHD. His $30,000 has ballooned to $57,000. Despite missing out on the massive tech rally of 2023, SCHD's relentless dividend growth and rock-solid fundamentals pushed his capital higher, proving that you don't need high-risk tech stocks to build serious wealth. And the winner of the 5-year sprint is Michaela with Fidelity's FDVV. Her $30,000 has exploded to $61,000. Because FDVV's algorithm managed to capture high yields while still participating in the massive broad market recovery, she takes the crown for total capital appreciation. Let this sink in. By doing absolutely nothing but holding and reinvesting, all three investors turned $30,000 into over $50,000 through some of the most chaotic economic years in modern history. That is the power of the ultimate lazy portfolio. But wait, the race isn't over. Capital appreciation is great, but true financial independence isn't about how much money is sitting in your account. It is about cash flow. It is about how much money that account pays you every single month so you don't have to work. Let's project this out another 5 years to January 2030, a full decade of compound interest. By this point, their portfolios are crossing the $85,000 to $100,000 mark. But we aren't looking at capital anymore. We are looking at the dividend payout. We are looking at the cash. This introduces the most important metric in dividend investing, the dividend growth rate. It's not just about what the ETF pays you today. It's about how fast they increase that payment every year. Claudia's VYM increases its dividend by roughly 5% to 6% a year. By 2030, her portfolio is generating around $3,200 a year in pure passive income. Michaela's FDVV, despite winning the capital race, has a slightly slower dividend growth rate. Her portfolio is generating roughly $3,500 a year in passive cash. But then we look at Eduardo. Remember why he chose SCHD? The quality filter. SCHD has a historical dividend growth rate of over 10% per year. It is a compounding monster. By the time we hit 2030, the math flips. Eduardo's portfolio is now generating over $4,500 a year and rapidly approaching $5,000 in completely passive income. While Fidelity won the short-term sprint for total capital, Schwab's SCHD wins the decade-long marathon for cash flow. Eduardo's snowball simply grew too fast for the others to catch up. So, what is the ultimate lesson here? Whether you choose the safety of Vanguard, the tech blend of Fidelity, or the aggressive dividend growth of Schwab, the real loser is the person who leaves their $30,000 sitting in a savings account, letting inflation eat it alive. There is no wrong choice between these three heavyweight ETFs. The only mistake is not starting your own snowball today. We bring the complex math of Wall Street to life through high-quality animation every single week. Now, I want to hear from you. Quick question. Are you Team Vanguard, Team Schwab, or Team Fidelity? Drop a comment below. I'd love to know where you are putting your money. Ready to live off dividends? Click the next video to discover top dividend and growth ETFs right now.